All right, let's dive into the world of taxes. Now, I know, taxes aren't always the most exciting topic, but whether you're just starting out, running your own business, or investing for the future, getting a handle on the two basic types, direct and indirect, is absolutely crucial for managing your money well. And really, it all comes down to a super simple question. What is the actual difference between the tax you see get yanked out of your paycheck and the tax you pay on your morning coffee? The answer to that question, well, it opens up these two hidden worlds of taxation that affect us every single day. That's right. Every single tax you ever pay, no matter how big or small, fits into one of these two buckets. And trust me, knowing which is which, it changes everything about how you see your money. Okay, so here's the main difference in a nutshell. Direct taxes are, well, direct. They go straight from you or your company right to the government. You see it on your pay stub, you know you're paying it, and you feel that burden directly. Indirect taxes, on the other hand, are a bit sneakier. They're collected by someone in the middle, like a retail store, who then passes that cost on to you in the final price. So the business technically pays the government, but you're the one who's really footing the bill. So let's kick things off with the ones we can actually see, the direct taxes. These are the ones you're probably most familiar with, precisely because there's no middleman, the money goes straight from your pocket to the government. And the king of all direct taxes is, of course, income tax. Here in the US, we have what's called a progressive system. And all that means is that the more money you make, the higher the percentage you pay in tax. The whole idea behind it is to create a more fair way of spreading the tax load across everyone in society. And this is where we can bust a huge myth about taxes. So many people worry that a raise will push all their money into a higher tax bracket. Nope, that is not how it works. The best way to think about it is with these buckets. Your income fills up the first bucket at the lowest rate. Once that's full, the rest of your money spills over into the next bucket, and only that amount is taxed at the higher rate. It's such a critical thing to understand. Okay, next up is a big one for anyone who invests their money: capital gains tax. It sounds complicated, but it's really not. It's just a tax on the profit you make when you sell something, like stocks or a house, for more than you originally paid for it. Simple as that. Now with capital gains, timing is everything. Seriously, if you sell an asset you've owned for less than a year, that's called a short-term gain, and you get taxed at your normal higher income tax rate. But if you just hold on to it for more than a year, it becomes a long-term gain, and you get a much, much friendlier tax rate. This little detail is the bedrock of any smart investing strategy. And finally, we've got property tax. If you own a home or any real estate, you know this one. It's a direct tax you pay based on the value of your property, and the rates are set by your local city or county government. It's a major ongoing cost you have to factor in. Okay, so let's shift gears and step into that other world of taxation, the world of the hidden costs. These are the taxes we're paying all the time, sometimes without even thinking about it. Probably the most common indirect tax you run into is sales tax, right? It just gets tacked on at the end of your purchase. But in a lot of other countries, they use a more sophisticated system called a value-added tax, or VAT. And unlike a simple sales tax, VAT gets collected at every single step of a product's journey, from the raw materials all the way to you. So let's see how that works with a t-shirt. The company that makes the fabric charges the t-shirt manufacturer VAT. Then the manufacturer charges the retail store VAT. At every stage, the business is basically acting as a tax collector for the government. And all of those little taxes get rolled up and baked right into the final price you, the consumer, end up paying. So we know what these taxes are now, but the really big question is, why does any of this matter? Well, it matters a whole lot, because this distinction has huge implications for what we consider to be economically fair. You see, taxes aren't just about raising money for the government, they're a powerful policy tool. A progressive system, like our income tax, tries to be fair by taking a bigger percentage from those who earn more. A proportional or flat tax takes the exact same percentage from everybody. And then there's a regressive system, which actually ends up taking a bigger chunk of income from lower income folks than from the wealthy. And this is exactly why so many indirect taxes, like sales tax, are called regressive. Think about it. A high-income family and a low-income family might both pay the exact same $1 in sales tax. But that $1 is a much, much bigger piece of the pie for the low-income family's budget. Yeah, to put it really simply, that $1 tax on a loaf of bread is felt way more by a family that's struggling to make ends meet than it is by a family that's well off. The amount of tax is identical, but the actual economic burden, it's completely different.
So let's bring it all back home. Now that you've got the lay of the land, how can you actually put this knowledge to work for you and your own finances?
Well, if you're a business owner, you're really fighting a war on two fronts. Your direct taxes, like your corporate income tax, hit your profitability, your bottom line. But your indirect taxes, like sales tax or VAT, are all about cash flow. You have to remember that tax money you collect from customers isn't actually yours. You're just holding it for the government, and you've got to manage it carefully.
And if you're an investor, man, understanding this system is key. Actively planning your trades to take advantage of those lower long-term capital gains rates can literally save you thousands of dollars. And using tax-advantaged accounts, like a 401k or an IRA, lets your money grow and compound without taxes eating away at it every single year.
So there you have it, the two worlds of tax, the one you see and the one that's kind of hidden in plain sight. They impact your paycheck, everything you buy, and all of your investments. So the only question left really is this. Now that you know the rules of the game, how are you going to play it?